Top of the morning, Dan and Amy. We're just coming out of a financial panic, and will we be dutifully heading into another one because of the policies we chose in furtherance, according to the politicians, of getting out of the one that was induced by the response to COVID last year? Well, let's get some historical perspective on what causes crashes, recessions, depressions, the government policies, the market forces, the Deus Ex Machina events. We're pleased to be joined by Thomas Vartanian, Executive Director of the Program on Financial Regulation and Technology at George Mason University's Antonin Scalia Law School. He's also a professor of law there. The book, 200 Years of American Financial Panics, Crashes, Recessions, Depressions, and the Technology That Will Change It All. Professor Vartanian, thanks for joining us again. Appreciate it.
Thanks, Dan. Great to be here.
So, the shutting down the government, it was sort of a unique event in American history. Not sort of, it was a unique event in American history last year. But in terms of the policy responses, not unique. Maybe the scale is unique, but not unique. When you put the printing money into context, when you look at other recessions or even depressions, how do you assess the potential impact of what was done last year into this year?
Well, it's a terrific question, Dan, because I think there's a price to pay for all of these actions. And it's not that the actions were taken with any malice, of course. They're all well-intentioned, but the problem is by just printing money and piling up assets on the balance sheets of the Federal Reserve Board, we're going to run into some significant problems in the long run. Let me give you two examples. 24% of all the dollars in circulation today have been created in the last year. Second of all, the Fed's balance sheet today has $8 trillion in assets on it. Before the 2008 crisis, there was about $800 billion in assets on the Fed's balance sheet. So you can see that we are completely distorting the economy to save it. And in the long run, that's going to have repercussions because it distorts the market. And when the market gets distorted, things happen that are unanticipated.
Well, I mean, what's a good is there a good example or comparison from American history with this kind of a printing of money and ultimately how it was unwound? Anything that gives us some insight into what the consequences may be today or, in the near term?
Yeah, I mean, you can go back to 1837 when Andrew Jackson shut down the Bank of the United States and moved an enormous amount of capital from the East Coast to the West Coast, creating all kinds of distortions in the marketplace, which caused the Depression of 1837. You can look at the Depression of 1929, when the Fed took actions that have been, to this day, significantly criticized for actually inflaming the factors that caused the Great Depression. So again and again, the government makes a number of decisions, again, well-intentioned, but many of those decisions are not well thought out, and eventually they result in crises. And so the interesting thing, Dan, is that since the creation of the Fed in 1913, we've had three significant financial crises, all of which have been more severe than all the crises before them. And all of those crises, since in the last 200 years, are more than any other country in the world has had, except Argentina.
Well, that's just one more point. That's really interesting because that's where I was going to go. That's such a key point. And first of all, Milton Friedman, I think, gave the definitive case for the Fed exacerbating the Great Depression of 1929. But I don't think people appreciate it because it's been around for 108 years. But the Fed hasn't been with us. Federal Reserve hasn't been with us since the country's founder. This wasn't the founder's idea. It was the idea of monetarists and central planners, and so that's why I wanted to get a handle on pre-Fed versus post-Fed, how deep the recessions and depressions have been, and how much of that is attributable to the Fed. And you seem to put a lot of weight or a lot of responsibility at the Fed's doorstep.
Well, I think you can put responsibility at the Fed's doorstep, but like every financial panic, they are very complicated and complex sets of factors that go into them. And what I found in doing this research over the last 200 years, and in fact, living at ground zero while I was practicing law in the financial services business for the last 45, is that government policies, including the Fed, but government policies, the Fed, presidential administrations, have done things that in the long term have actually backfired and caused financial crises or facilitated them. And the savings and loan crisis was a great example. The 2008 crisis was a great example. And the interesting thing that I found and knew from my practice, Dan, was that over this 200-year period, even when we had financial regulators, no financial panic in this country has ever been predicted. No financial panic has ever been expected. And we have never been prepared for any financial panic. And you have to ask yourself, if we're going to have a regulatory system of oversight and supervision, shouldn't it at least be prepared for these kinds of events? And that's where I get into technology and how technology can help the regulators in the future.
Well, I mean, yeah, right. Is there any predictive value that comes from those who have quote unquote oversight on our economy? And the answer seems to be no. I mean, what's the old joke about economists predicting 10 of the last 5 recessions? I mean, they're
right.
So again, that's another story. That's a larger story about being governed by quote unquote experts.
Yeah, look, I mean, we have the best regulators on the planet. The problem is we don't give them the best tools, and Congress doesn't give them the best direction. Congress has very often got the regulators looking right when they should be looking left. And if the regulators had artificial intelligence and big data tools that Facebook and Google and Amazon use, they'd be able to regulate a lot better. When I was regulating financial institutions back in the Reagan administration, we basically had to do a lot of guessing. Well, you don't have to do that guessing anymore. If you've got big data and artificial intelligence evaluating every financial factor of the last century and giving you predictive analysis, that you can make judgments about it. It's not that you accept those analyses at face value, but you use them with your judgment as a regulator to do something, I think, which would exceed the ability of our system today.
Well, then what does your research suggest about the next financial crisis?
Well, it's interesting. What I've concluded is most of the time we are embedding in the economy what I call financial IEDs. There are a lot of different things in the economy that could cause a crisis. There's student loans, leveraged lending, mortgage-backed securities. They're all out there, and they're all, in good times, growing at a rapid rate. The question becomes, and I've seen this in every one of the 10 financial panics I looked at over the last 200 years, is there's a flashpoint. There's some point where something happens that evaporates the confidence in the marketplace. And once that confidence evaporates, that's when all those IEDs, those financial IEDs in the economy start blowing up and start working together to bring down the economy, shrink credit in the economy, and devalue the assets in the economy. And that is the pattern that has occurred in every single one of these. So the question is, what's the flashpoint that's going to cause the next financial crisis? And that's the great unknown.
When you think about the last one, the recession of 2008, 2009, the Great Recession, which I think there's been more books and movies made about that than there was the Great Depression. People try to make comparisons to, what they've lived through, what they know. And so I think one of the things that people are talking about, in addition to inflation now, which is not comparable, but is housing prices and the fact that Q1 over Q1, 2021 to 2020, every metropolitan area in this country saw their home prices increase except Springfield, Illinois. So we're talking about mid-size as well as obviously major. Every single one. And are wondering, some people suggesting, are we not learning any of the lessons from the Great Recession and re-blowing up a housing bubble?
Well, I think we never learn our lessons, Dan. That's the great lesson of looking at this period of 200 years. But I think you're exactly right. The factors today look eerily like the factors that existed in the 1920s before the Great Depression in 1929. They look eerily like the factors beginning in the 2000s that led up to the 2008 crisis. And yes, we are building financial bubbles out there, and the real estate bubble, particularly the residential real estate bubble, really concerns me because every time I've seen those in my 45-year career, they have resulted in some sort of financial disaster somewhere down the line. Again, when all of these factors sort of come together and there's an economic flashpoint that eliminates and removes confidence in the marketplace.
And not learning the lessons from the Great Recession to present, Fannie and Freddie are as prominent as they were. Is there anything else that that strikes you as similar with respect to perhaps? I know it's counterintuitive with everybody focusing on inflation and obviously real property is a hedge against inflation. But is there anything else that suggests that we should be concerned about the housing market?
I think when we see the housing market expand as it has expanded in the last few years with unlimited credit and the speed and velocity of that growth, that's when we should be concerned because every time we see that kind of speed and velocity in the increase in housing around the country, that's got to stop somewhere, and how it stops and when it stops, of course, determines whether or not we have a panic or not.
When you talk about technology making for better regulation, can you be more specific? Is this to be more surgical or what? I mean, it seems like per your research and sort of one of the top line takeaways that misguided government policy is at the foundation of all of these crashes, recessions, and depressions, that we should have a much smaller regulatory footprint over the marketplace in addition to being more surgical.
Yeah, and it's an interesting question. So, you have the people who say we need more regulation with a bigger footprint. There are those who say you need a smaller footprint. I tend to believe something in the middle. I don't believe that the large footprint of regulation has actually helped get us in the right direction in terms of financial regulation. I think we need smarter regulation. And what I mean by that is we need, number one, to stop looking backwards when we regulate. When I was a regulator, it was pretty clear, and it still is today, that much of the focus is on what a financial institution has done in the last few years. Well, we live in an environment now where the velocity of change in technology and the internet doesn't allow you to try to figure out where you've been. You've got to figure out where you are and where you're going. And so we've got to get financial regulation on a real-time analysis basis, which it is not today. Second of all, I believe that the 2008 crisis could have been preventable or at least could have been foreseen if the government was using artificial intelligence, big data, and technology tools rather than doing the things that they were doing to sort of micromanage the business. But look at the big picture and try to figure out what the trends are and let the machines, the super machines, tell us something about where we're going so the regulators can use that information to avert the crises that may be imminent. And we don't do all of that, any of that, and we don't regulate on a real-time basis. And that's a critical change that can affect the future of this country financially.
Well, this will be a welcome addition to the scholarship, particularly around '08 and '09, since we've got stylized versions of history from like Michael Lewis's Big Short, which doesn't account for any government role in what happened in 2008, 2009, which is just remarkable. But again, so that becomes the sort of the popular urban myth, and thus the lessons aren't learned. So appreciate your hard-headed research in this area. Thomas?
Well, part of the reason I wrote this book, Dan, is because I was on the ground 45 years involved in all these crises, taking over financial institutions, recapitalizing them. And I thought that everything I'd ever read really didn't capture the real sense of what's going on because it was written by people who were looking at it rather than were involved in it.
He is Professor Thomas Vartanian, Executive Director of the Program on Financial Regulation and Technology at George Mason University's Antonin Scalia Law School, where he's a professor of law. The book, 200 Years of American Financial Panics, Crashes, Recessions, Depressions, and the Technology That Will Change It All. Professor Vartanian, thanks for joining us again. Appreciate it.
Dan, thanks very much.
And thank you. And he joined us on our turnkey.pro answer line.
It's what Chicago is talking about. It's Chicago's Morning